Hey everyone, welcome back to Corporate Decoder. Today FERG just filed an 8K reporting a new material agreement, and I'm seeing how they are funding their big acquisition. Quick note, this is not financial advice, just my take on public filings for educational purposes. Ferguson is lining up some serious credit to make a major purchase happen, and we're going to break down what that means for their financial health. So Ferguson Enterprises Incorporated, a big name in industrial distribution, has just filed a current report, an 8K. This usually means something significant has happened that the public needs to know about, and in this case it is all about how they plan to pay for a major acquisition. The big news is that on the 11th of August 2026, Ferguson Enterprises, acting as the borrower, signed on the dotted line for 2 new credit agreements. Think of these as big loans that will help them get the cash they need for their previously announced acquisition of FloWorks Incorporated. First up is a bridge credit agreement. This is essentially a short-term loan designed to give them immediate funds. It is for up to $700 million and is set to mature 364 days after they actually take out the money. The whole point of this bridge loan is to cover part of the cost of buying FloWorks, but only if Ferguson hasn't secured enough money from other financing sources by the time the deal closes. It's like a financial safety net to ensure the acquisition can go through smoothly. The clock is ticking on this as it's tied to the completion of the FloWorks acquisition. Then there is the term loan credit agreement. This one is for a larger amount, up to $900 million, and it is a bit longer term. This loan is also unsecured, meaning Ferguson doesn't have to put up specific assets as collateral. It is set to mature 3 years after the funds are actually drawn, just like the bridge loan. The money from this agreement is earmarked for the FloWorks acquisition costs. This loan also has conditions tied to the acquisition's completion. Now, let's talk about the interest. Both loans will charge interest at a rate that Ferguson can choose, either a base rate or something called the term SOFR rate. On top of that, there is an added percentage called an applicable margin, which depends on Ferguson's credit rating. For the base rate loans, this margin can be anywhere from 0.000% to 0.250%. For the term SOFR rate loans, it is a bit higher, ranging from 0.750% to 1.250%. These rates are pretty competitive, especially the lower end, which suggests Ferguson is seen as a relatively safe bet by the lenders. These agreements also come with some strings attached, as most loans do. Ferguson has agreed to certain promises called representations and warranties, and has to follow certain rules known as covenants. These include restrictions on taking on more debt through subsidiaries, taking out additional loans, or selling off parts of the business, all subject to certain conditions. Crucially, Ferguson must maintain a certain financial balance. On a consolidated basis, they need to keep their net leverage ratio, that is basically how much debt they have compared to their earnings at, or below 3.5, 0 to 1.00. This is a pretty standard financial metric that lenders use to gauge a company's risk. They do get a temporary break though, with a step up allowed to 4.00 to 1.00 for a few quarters after making significant acquisitions, which makes sense given they are actively buying other companies. This brings us to another part of the filing which basically confirms that Ferguson has entered into these significant financial commitments. It's a direct reporting requirement for this kind of major borrowing, and you can find all the nitty-gritty details of these agreements in the exhibits attached to this report. Exhibit 10.1 is the bridge credit agreement, and Exhibit 10.2 is the term loan credit agreement. These documents contain the full legal terms and conditions. The report is signed off by William Brundage, who is the Chief Financial Officer of Ferguson Enterprises. This is standard practice for these kinds of filings, showing that the company's finance leadership is aware of and responsible for these agreements. So, what does this all mean? Ferguson is demonstrating a clear strategy to grow through acquisition, specifically with the FloWorks deal. They are securing substantial financing, both short-term and medium-term. To make this happen, the terms seem reasonable, and the company appears to be in a strong enough position to secure these loans. However, the leverage ratio covenant means they will be under pressure to manage their debt and earnings effectively, especially after the acquisition. They are clearly betting on the FloWorks acquisition to be a success and help them maintain their financial health. The risk I'm watching is how well they integrate FloWorks and if the expected synergies materialize to keep that leverage ratio in check. My biggest concern is always the execution risk on large acquisitions, but Ferguson's ability to secure this level of funding suggests confidence from the lending side. What I am actually looking for is the subsequent financial reports to see how this acquisition impacts their bottom line and overall debt structure. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.